Hey there, future millionaires! Welcome to the fascinating world of the stock market. Ever wondered how companies like Apple or Amazon got so big? It's not just about selling products or services, it's about raising capital to grow and innovate. It's all thanks to the stock market. This is where companies go to raise money by selling shares of their business to the public. Think of it as a giant flea market. But instead of old lamps and vintage clothes, you're buying and selling pieces of companies called stocks. Just like at a flea market, prices can go up and down based on demand. These stocks represent ownership in the company. When you own a stock, you own a piece of that company, no matter how small. When you buy a stock, you're basically becoming a part owner, even if it's just a teeny tiny part. This means you can benefit from the company's success through dividends and stock price appreciation. The stock market is where this buying and selling happens every weekday. It's a bustling hub of activity where fortunes can be made or lost. It's exciting, it's dynamic, and with a little know-how, it can be your ticket to financial freedom. But remember, investing in the stock market also comes with risks. Prices can be volatile, and it's important to do your research and understand what you're investing in. Many people seek the help of financial advisors or use online resources to learn more about investing. There are also seminars and courses available to help you get started. It's also important to be aware of the history of the stock market, including its ups and downs. Understanding past market crashes and booms can give you a better perspective on current market conditions. So whether you're a seasoned investor or just starting out, the stock market offers opportunities for everyone. With patience, knowledge, and a bit of luck, you could be on your way to achieving your financial goals. Happy investing! Now, before you dive headfirst into this exhilarating world, you need to decide what kind of market player you want to be. This decision is crucial because it will shape your entire approach to the stock market, your strategies, and ultimately your financial future, an investor or a trader. These two roles, while both integral to the financial markets, are fundamentally different in their objectives, strategies, and time horizons. Investors are like marathon runners. They buy stocks for the long haul, aiming to grow their money slowly and steadily over time. Think years, even decades. They focus on the underlying value of companies, often diving deep into financial statements, management quality, and industry trends. Their goal is to build a diversified portfolio that can weather market volatility and deliver consistent returns over the long term. Traders, on the other hand, are more like sprinters, darting in and out of positions quickly, trying to capitalize on short-term market fluctuations. They rely heavily on technical analysis, chart patterns, and market sentiment. Their focus is on timing the market to make quick profits, often within days, hours, or even minutes. This fast-paced approach requires constant monitoring of the markets and a high tolerance for risk. Both approaches have their own risks and rewards. Investors might face the risk of market downturns affecting their long-term holdings, but they benefit from the power of compounding and potential dividends. Traders, while having the potential for quick gains, also face the risk of significant losses due to market volatility and the pressure of making rapid decisions. The key is to choose the one that aligns with your financial goals and risk tolerance. Are you looking for steady growth over time? Or are you excited by the thrill of quick trades? Understanding your own financial objectives, time horizon, and risk appetite will help you make the right choice. Remember, there's no one-size-fits-all answer. Your path in the financial markets should reflect your personal preferences and financial aspirations. Let's get down to brass tacks and decode some stock market jargon. First up, stocks and shares are often used interchangeably, both referring to a piece of ownership in a company. Then there are dividends. Think of them as little thank you gifts from companies to their shareholders. These are payments made to shareholders from a company's profits. Sweet deal, right? Finally, market capitalization is the total value of a company's outstanding shares. Basically, it tells you how big the company is in the eyes of the market. The stock market is like a roller coaster with its ups and downs, often influenced by factors like economic news, political events, or even just plain old investor sentiment. These ups and downs are what we call market trends. A bull market is when prices are generally rising, making investors optimistic. Conversely, a bear market is when prices are falling and pessimism prevails. Understanding these trends can help you make smarter investment decisions. Section 5. Baby Steps on Wall Street. Starting your investment journey. Ready to dip your toes into the stock market waters? The world of investing can seem intimidating at first, but with the right approach, it can be a rewarding journey. Whether you're looking to grow your wealth, save for retirement, or achieve financial independence, the stock market offers a plethora of opportunities. There are more ways than ever to get started. From traditional stocks and bonds to modern investment vehicles like ETFs and robo-advisors, the choices are vast. Each option comes with its own set of benefits and risks, so it's essential to do your research and understand what aligns best with your financial goals and risk tolerance. You can open an account with an online brokerage, many of which offer educational resources and low fees. These platforms are designed to be user-friendly, making it easier for beginners to navigate the complexities of the stock market. Look for brokerages that provide tools like stock screeners, research reports, and even virtual trading accounts to practice without risking real money. Another option is to invest in mutual funds or exchange-traded funds, also known as ETFs, which are like baskets of stocks that offer instant diversification. These funds are managed by professionals and can be a great way to spread your risk across multiple assets. They are particularly useful for those who may not have the time or expertise to pick individual stocks. Remember, you don't need a fortune to start investing. Many platforms allow you to begin with as little as $5. The key is to start early and be consistent. Small, regular investments can grow significantly over time, thanks to the power of compound interest. This means that the returns on your investments start generating their own returns, creating a snowball effect that can lead to substantial growth. Even small, regular investments can add up over time thanks to the magic of compound growth. Imagine planting a seed and watching it grow into a tree. The same principle applies to your investments. By reinvesting your earnings, you can accelerate your wealth-building process. So, take that first step, educate yourself, and start your investment journey today. The sooner you begin, the more time your money has to grow. Section 6. Rookie No More Top Tips for New Investors. Entering the stock market can feel like stepping into a casino, but with a little knowledge you can stack the odds in your favor. Firstly, do your homework. Research companies, understand their business models and financials before investing. Don't buy into hype or follow the herd blindly. Secondly, be patient. Investing is a marathon, not a sprint. Don't expect to get rich quick. Stay focused on your long-term goals and ride out the market's inevitable fluctuations. Section 7. Diversification. Don't put all your eggs in one basket. You ever hear the saying, don't put all your eggs in one basket? Well, that couldn't be truer in the stock market. Diversification is key to managing risk. Spread your investments across different companies, industries, and asset classes. That way, if one investment goes south, your entire portfolio won't go down with it. Remember, a well-diversified portfolio is like a safety net for your investments. Section 8. The long game, patience and consistency in investing. The stock market is a powerful wealth-building tool, but it's not a get-rich-quick scheme. Success in investing requires patience, discipline, and a long-term perspective. Don't get spooked by short-term market swings or panic sell when things get bumpy. Remember why you invested in the first place and stick to your plan. Consistent, disciplined investing is the key to reaching your financial goals. Section 9. Unlock your financial future, the power of stock market knowledge. So there you have it, a crash course in the stock market. It might seem intimidating at first, but like anything else, knowledge is power. The more you learn about investing, the better equipped you'll be to navigate the market's ups and downs and make informed decisions with your money. Remember, investing is not just for Wall Street hotshots, it's for everyone. Start small, stay informed, and watch your money grow.